Okay, we're going to get to the financial planning portion of the presentation. We have Scott Frailer. Scott is our financial planner from Blue Line Wealth. He has an office right in the PBA building. He is also a steward of all our investments, keeps us our funds solvent. I use Scott. Scott does a great job. He is a constant resource. We'll look at your deferred comp. We'll help you elect there. Can help you with the retirement planning. And again, always available and great. Scott?
Sounds good.
There you are, sir.
Thank you, Lou. Thank you, everybody, for sticking around. I'm sure Bill would say the same thing. It's good to see a full house instead of empty seats. A couple years ago, I think this was a flood zone for any of you guys or ladies that might have been here. So we're definitely off to a better day so far. So let me just get started. Sorry, I was just trying to log on. So I am Scott Frailer. I am the president of Blue Line Wealth Management. As Lou stated, we are privileged to do the investments for the Suffolk County PBA and the Suffolk Detectives Association. I know there's a bunch of detectives out here as well. One of the things we pride ourselves on is educating you, not necessarily just speaking to you and telling you this is what you need to do with your money. So we want you to be fully educated, making the best possible decision that you could possibly have for yourself. So as we get going today, keep going. These slides are just basically saying these are my opinions. It might not be the opinions of somebody else. So, okay, topics of discussion for today. First of all, we're going to talk about a retirement puzzle, picking a pension option, separation pay, deferred compensation / 401A, partial lump sum, whether it's a good idea, not a good idea, and the options that you have. And certainly we'll give you a couple of things that we think we are different than the competitors. Okay, so the retirement puzzle. The first thing that I will tell everybody in this room, the most important thing for you, and some of you might laugh when I say this, and some of you might know exactly what I'm talking about. The first thing, are you ready to go? What we see with retirees, the ones that tend to struggle with it, are those that are not yet ready to go. And again, some of you might have been ready to go 10 years ago. Some of you are vacillating, whether it's this January, next January, July, etc. Just make sure you're ready. That's the one thing that we can tell you before anything else. Picking a pension option. This is a multi-million-dollar decision. This is not something to take lightly. You know, I was asked a couple of different times today, when should I come in to see you if I'm, maybe thinking about different options, or what do I do with my investments? Certainly you can come in anytime. You can come in 5 years prior to retirement. You can come in 5 days. But if many of you out there are looking to retire in January, I would say in the next couple weeks would be a very good time for you to make that decision, so that way you can fully comprehend, 401A, do I do the second year? Do I not? Is July a big deal? Is it not? Are there advantages or disadvantages to staying or going? The big thing with the time horizon we were just discussing there is some of you might have a question and say, should I take life insurance in lieu of a pension option? I will tell you in 90% of the cases, I do not recommend life insurance versus the pension. We can certainly provide it for you. It's a stream of revenue for us that we do have. But in most cases, like the partial lump sum, you might find out that although that would be advantageous for our firm, we might recommend against it. How long do you need to get everything in order? Well, you're going to want to see the county. You're going to want to do different things. You're going to need to see John or Paul if you want to do the deferred comp catch-up. So I would say 45 days is a good basis for you to start talking to the county, talking to the people in your union, and certainly maybe coming to see me or someone that does what I do. Timelines for submission and then receiving your funds. Easiest way to explain this. The earlier you retire in the month, the less pay you're going to get. Common sense, but sometimes people forget, right? So if I retire on January 3rd, I'm going to get a paycheck on or about January 15th. I'm not going to get a paycheck on the 30th. I'm not going to get a paycheck on February 15th. And I'll get my first pension check somewhere around February 28th, and then they will go forward with that. As you all know, nobody's numbers are going to be 100% accurate. It's taking on average 2.5 to 3 years to be finalized. It doesn't mean you're getting half your pay. You're probably going to get about 95% of your pension when you start getting your pension checks, but understand the number is not going to be your whole total. So if you're worried or need a couple funds, maybe the best idea would be to retire at the end of the month, because if you do, in theory, you'd only miss one paycheck instead of potentially 2 or 3. If you have enough capital, then it doesn't matter. That money will be backfilled with your pension. So it's not like you're losing it. It's just like you're not going to have it discretionary moving forward. Okay, picking a pension option. Everyone's status here is unique, right? Some of you are single. Some of you are married. Some of you are divorced. Some of you have kids. Some of you don't have kids. Some of you might have a special needs trust. There's a whole bunch of different things that comprise why you would pick one pension option versus the other. And again, in an individual consultation, this is something that we would review. And in theory, we all want to look at the pension option that we can select for our partner. And we don't want to spend any more dollars than we have to protect them. But sometimes actually taking a richer pension option allows you to more readily access funds from deferred comp, 401A, IRAs, or whatever. So you might spend a couple extra dollars to provide a pension option for your spouse, partner, whatever, but that will allow you so much more opportunity to access those retirement funds that you saved. So again, something to think about. It's not just, hey, I'm taking the joint allowance full, or I'm taking the joint allowance, or I'm taking the single option 0. There's so many different options, and on its face, something might be the clear way to go, but there might be other options for you to take. Gross versus net take-home pay, right? If we're in the state of New York, we don't pay state tax, we don't pay FICA on our pension. We basically just pay the federal tax. Going back to the picking a pension option, some of you might be part of a bi-pension family, right? You might be married to a teacher, another police officer, somebody else that has a pension. One thing to keep in mind with that is, if you both decide, hey, we both have great pensions, we're both going to take the single option 0. And that might be an option that you decide. But one other thing to remember with that is, while you're both alive, you both get Social Security. In the event that somebody passes away, the remaining spouse receives the higher Social Security. But you lose the other person's Social Security, correct? So therefore, maybe one of the options you might consider is the 25% pension option. Even if you're going to take this single option 0, maybe it's cost effective to do the 25%, which in most cases pretty much matches what Social Security would have been, and it's a cheap option to provide that extra little bonus for your spouse, God forbid something happened to you. Pop-up versus no pop-up. Listen, Darwin's going to be pretty clear on this, and I've sat through enough of Mr. Reithman's presentations to know that the real thing is men tend to not outlive their spouses, right? Wives tend to live longer. So if you're going to pay up for the pop-up option, understand that you're probably going against science. However, the dollar values in order to take this option, it's not expensive. It's definitely something I would probably take if I was in any of your positions out here, whether you're a female, male, it's probably a good option to take the pop-up. Spousal pension, we already kind of addressed that. If you're part of a 2-pension family, also might be a reason to take a plop, whereas maybe if you're not, might not be a good idea. And one last thing to take into consideration is inheritance, right? Some of you out there might be expecting a significant inheritance. Some of you might not be expecting anything. Some might have large college loans you're paying off. Some might have saved enough, or kids were fortunate enough to get scholarships, so you don't have that. All of these things complicate the retirement puzzle, but when you get it on paper, you talk your way through it, you make the right decisions, it becomes easier and easier over time. Okay, so what happens to your SCAP pay, right? This is this is probably the number one question we always get. So the first thing that you should do, I would recommend, deferred comp is fully liquid when you retire. There is no reason not to do the catch-up. No reason. You put it in, you take it out. You're going to defer the state and federal taxes until you take it out. The good news with that is, if you put away 45, that was the number for last year, and you only need 20, why do you want to pay taxes on the other 25, right? So the first thing I would tell everybody to do, and everybody that comes to see me, make sure you go upstairs and see John, or you go to the SDA office and you make sure you do your catch-up. The second thing, 401A was put in several years ago. Last year's value was $69,000. That $69,000 avoids federal, state, and FICA taxes. Those dollars are completely liquid and available to you if you meet one of two criteria. One, you're turning 50 in the year you retire. If you are turning 50 in the year you retire or older, you have no issue with liquidity in a 401A. Or if you have 25 years of service in the police department, doesn't have to be Suffolk, but in a police department, you are also eligible to take that money out without any penalty. Should you not make one of those two requirements, the dollars in there are required to stay in there till age 59 and a half without penalty. But as we just said before, your deferred compensation is fully liquid, so you'd have to go through all of that before you'd go to the 401A. But if I don't meet the criteria, if I'm 45 with 20 years on the job and I'm going to retire, I probably don't want to sign the letter and take the second year 401A option if I think I'm going to need those funds. And again, I'm sure it was gone over earlier in the day. Between November 15th and December 15th, if you sign a mandatory letter that you're going to retire by the end of January, you can get the second option of the 401A, which if they double last year would be $138,000 you could have put away before tax. And again, as long as you meet the criteria, it's fully liquid to take the money out. The remaining part of that is obviously a check to you. If you're fortunate enough to have a SCAT check that large and you're going to get a remaining check, that's going to go to you. Okay, so what is the effect of the county's 401A plan? First $69,000 of your separation pay will be deposited into the account. What we discussed before, you don't pay the FICA and the 7.65, you don't pay state and federal until you take the money out. Now the money is in the plan. What are my options? Well, it goes into a stable value account, so it sits in a fixed account. Okay, so it hits the fixed account, so you don't have any chance that you're going to lose any of these funds. You can leave it in there and reallocate the portfolio within the 401A plan. You can remove those assets and put it into a retirement account. Whether you decide to take that money out, you might put it into T. Rowe Price. Understand it's not deferred comp money, so it's held in T. Rowe Price, but in a separate sleeve. You could come sit with somebody like me. You could use the money you might want to put it into an IRA, right? If you put money into an IRA, the thing to keep in mind, it's 59 and a half, unless, of course, you're using that money for some eligible withdrawals, such as the tuition for college. You can pull that money out and not pay any 10% penalty. So we'll go over the options with IRAs in a minute, but understand that the money sits in the account in a fixed account. You can certainly leave it there. You can reallocate it within the portfolio. You can move it out to a retirement account. You don't have to move the whole thing out, just like T. Rowe Price. You can move part. You can take out part. You can take partial withdrawals. You could convert it to a Roth IRA. There's a bunch of different things you could do. All of these options are available to you. All right, separation cash. So now you've put your money in the 401A. You have money in the deferred comp. I now have liquid assets in my possession. My bank account is now a little more flush than it might have been a couple weeks before. What do I do with this money? Well, the first thing you want to do is do a debt analysis. Do I have credit cards that I'm paying an exorbitantly high rate on? Well, you probably want to get rid of those. You might say, I'm really nervous about the market. I don't know investments. What can I do with this? Maybe it's as simple as putting the money in a CD. Right now, our CD rates are probably going to be as high as they're going to be in the next 2 years. Fed's cutting rates. So if you have money, and this goes for anybody there right now that doesn't have, a goal with your funds over the next 6, 9, 12 months, you're not going to have higher CD rates than you do right now. So that might be something that you want to do. But let's say you say, I've been pretty successful investing during my career. Scott, what are some good ideas? Well, the first thing I tell you is you want to make sure you're going to keep this money absolutely liquid, meaning you can touch it whenever you need it. The second thing is you want to be as tax efficient as you can possibly be with these assets. So you want to invest it to your risk tolerance, which typically speaking, if we're retired and we're looking at accessibility of the funds, we don't want to be full hyper growth. We probably want to be in more of a balanced account. And we want to, again, use investments that are going to be tax friendly to us. Now, everybody in this room has probably had a deferred comp account, has a deferred comp account, etc. I am not suggesting that you take a lump sum of money and you throw it into one of these models. The best way to do it moving forward, and hopefully the internet here is going to work, and I'll show you a little illustration, is to do the same thing you've done for the last 20 or 30 years. Take a couple bucks out of your bank account because you can't do payroll deduction anymore. We throw it into one of these tax managed accounts. You can increase, decrease, start, stop. Do whatever, however you'd like. But understand the same compounding effect will happen. You put $1,000 a month in, $500 a month in, whatever it might be, over 10, 20 years, hundreds of thousands of dollars will be in there. And unlike your deferred comp 401a IRA, should you pass away, those assets are going to be tax-free to your children or whoever you want to leave it to in most cases. Some things to consider, we just talked about tax managed portfolios. You can certainly use municipal bonds because they're going to be tax-free interest. You can use stocks, you can use CDs. You can basically do whatever you want, just like you can now. But just remember, have a bias to being tax efficient. Deferred compensations. Should you switch to an IRA? What are my investment options? So, T. Rowe Price has great funds. Okay? One of the things that I try to stress to my clients, especially as you're approaching 59 and a half, is if you're staying in New York and you have significant retirement assets, use that $20,000 a year that New York State allots for you to not pay state tax. Again, one caveat, don't do it in the year you retire because I'm sure you're going to have an exorbitantly high tax bill potentially in that year. So wait till the year after. But assuming all things are equal, 59 and a half comes, you're going to want to pull that $20,000. That's good for you and your spouse if you're married. You don't take 40 from one account, you take 20 from each, thus saving about 8% of New York taxes. Take that money, go on a trip, pay down debt, visit your kids, do whatever you want to do. Should you not need the money, maybe that's a good time to convert some of that money to a Roth IRA. Well, people might ask, what is a Roth? I've heard about it. I thought you could only put $7,500 in. When you're doing a conversion, you can convert that money. You can convert as much as you want. So that $20,000 comes in, roughly 20% goes to taxes, so $16,000 is going to go into a Roth IRA. Now you've made an account that was taxable, tax-free for you and or your kids in the future. So it's a good plan if you don't need the money. If you're over 59 and a half, the benefits of any retirement account basically become the same. T. Rowe Price, deferred comp, 401a, they're all the same basically when you're 59 and a half. So now that becomes a matter of comfortability. So do you like the funds? Do you not like the funds? What else is out there for me? Well, again, what I usually tell people is, let's say you're approaching 59 and a half and we're going to take that $20,000 a year. So the first thing I might say is, hey, let's leave $100,000, $200,000 in the T. Rowe Price Stable Value Fund so you can take no risk on that money. And now you basically have a bank account that you're going to go to every year to pull that $20,000. So no matter what the market's doing, up or down, left or right, going crazy, your money's safe and secure, right? But for the rest of the assets, you could certainly leave them in T. Rowe. They have great funds, particularly growth funds. But if you're looking to have a little bit more control, if you're looking to have some other eyes on the account, you can look at managed portfolios, which then remove the risk from you making your decisions to putting on a financial professional. There's benefits of both sides. We go over that explicitly in appointments. And I can tell all of you that I never recommend taking 100% out of T. Rowe Price at any time, especially if you're under 59 and a half. Another advantage of an IRA, in some circumstances, you can add additional death benefits to your accounts that you might not have in T. Rowe. Certainly, if you have 100% of your money in the Stable Value Fund, you're going to know what it is. God forbid you pass away. That's what your beneficiary is getting. But we've all been through 2008. We've been through 2022. Markets go up and down. The death benefit is whatever the account value is. Roth conversions we already went over. Okay, so again, kind of talked about this a little bit before. Managed portfolios, mutual funds, annuities, stocks, bonds, CDs, all of these things and more are available within the IRA space should you want to explore opportunities. It is not saying that any 401a, 457, 401k, whatever anybody might have out there is a bad product. It's not. But like there's a million colors in the rainbow to paint your room, there might be other investments that you might want to take a look at besides just what you currently have. Okay, another hot topic, partial lump sum. Partial lump sum, what is it? Is the PLS for you? PLS examples. So the partial lump sum went into effect in 2008. You are eligible to take between 5 and 25% of your pension out when you retire. You can do that one of 2 ways, 3 ways. One, you take a check to yourself, probably get hammered on the federal taxes, you don't pay state, and now you have your check. You could transfer the whole account to an IRA. Now you've avoided the taxes until you pull it out, but it's there till 59.5, or you can do a combination of both. The retirement system has this calculation done for you. So if you set up your New York State retirement login, you log into your account, they're going to tell you exactly how much of a partial lump sum that you could take. Typical retiree can get between $50,000 and $600,000 in their partial lump. Why would you want to do it? Well, immediately you have more money. That's one answer, certainly, for sure. You have more control of your assets. One of the big things I see is, if somebody would happen to be divorced and your ex-wife or ex-husband was getting a portion of your pension, this is a way that you can take some of the pension assets and give it either to your kids or to your current spouse. It may certainly limit the need for additional life insurance. If you pulled this money out, it's certainly, in most cases, going to grow. So therefore, you can kind of limit that. And again, you could take some to you and put some to an IRA. Now, remember, this money comes from the New York State pension system, so the principal is New York State tax exempt. Moving forward, should you take the partial lump, you're going to have to track that. You're going to have to track it to determine what is what is growth, what is not, what's principal, et cetera, to determine how much you can take out in a tax-free status. I say this all the time, all the time, all the time. If you're contemplating taking a disability retirement, do not take the partial lump sum. If you get the disability retirement, it's a great thing. Hopefully you're not, hurt to a level that it really, really impedes your life. But I can tell you what will really impede your life is having to pay the New York State back. And they're going to take that money and they might not say that you can roll this back in. They might make you pull your money, pay your taxes, come up with more money to pay them back at an 8% interest rate. So please, if you're thinking about disability, stay away from the partial lump sum. Another thing to consider, you can hit it. This is just basically if we had somebody that had a $100,000 pension, these are the numbers that you basically get. You'd have $307,000 on 25%, that would reduce your pension to $75,000. If you took the 61, it's $95,000, et cetera. Next one, $150,000, you get $460,000. That would reduce your $150,000 to $112,000. If you did the 5%, $75,000 gets you $142,500. So that's just kind of where that's going. What I tell people for the partial lump sum, and I don't know if the Wi-Fi is going to work so well. At the end of this, I'll try to kind of explain this for you because it'll also show what you could do with your SCAT cash. When you take the plot, it's a finite decision. If you take the 25%, PLS, it might cost you $35,000 a year. You're never getting that money back. There's no way to get it back in your account. After 11 and a half years, the state wins on that argument, so that's why they made it available, right? In theory, you get your $500,000, let's say, it grows to $1 million in 12 years. After taxes, that's $700,000. That's phenomenal. What I can tell you is, if you don't take the plop and you invest the amount that you would have reduced your pension by, by like year 8, 9, you'd probably have more in that account than you would in the plop after taxes. And certainly those dollars are tax-free to your kids. So what does that allow you to do? It allows you the flexibility to say, I'm going to do this forever. But let's say in year 5, you decide, hey, I want to get a place in Florida. I don't want to do the $3,000 a month into my account, Scott. That was going to be the plop. I'm going to drop that to $1,000. I'm going to put $2,000 in my mortgage. Or I'm just going to simply stop this account and do something else with it. If I were sitting in your chair and I had significant assets in deferred comp, I wouldn't be jumping to do the partial lump sum. It's not that I don't think it's a great plan. It is. It's especially attractive if you have somebody, again, that has a pension on their own. But if it's just you, your spouse doesn't have any guaranteed pension, your assets, in deferred comp are reasonably significant, it might be something that you just don't need. Because remember, the more money you have in your retirement accounts at 73, the government's going to force you to take that money. The more money you have in there, the more tax rates you're going to pay, the more taxes you're going to pay, and that's at today's rates. God knows where we're going, right? So again, for me, I'm an advisor. If you want to come in and say, hey, Scott, I have a $700,000 plop, can you invest it? Answer, sure. We're not going to turn that down. But in most cases, there's better ways to do it that will get you to the same place with more flexibility than necessarily taking the partial lump. It's not just about lowering your taxes. It's not saying, what if I get hit by a bus? A lot of these things are not likely scenarios. So again, it's analyze the plop, but I would not be decisive that I'm definitely taking it without talking to a professional. So again, here's your typical retirement picture. You've done your catch-up. You've done the 401a, whether 1 or 2 years, right? 1 or 2 years, one of the big considerations. How old am I? Do I meet the 25-year, exemption, or am I turning 50 years old? If I meet either of those two, I'm 1,000% doing the 401a. Let me also kill something that might be out there. My firm, me, Scott Frailer, I have, never have, will not have anything to do with the 401a plan. We do not hold your assets. We never have. When we get calls about that, like, hey, we gave you your $69,000, I need it. It's not us. We're certainly happy to advise you and give you some advice on what funds to use in there. We can certainly advise you if you'd like to pull the funds out, just like T. Rowe Price. We have as much to do with the 401a as we do with T. Rowe Price. So I know sometimes people think that, and in a good way, they're like, hey, that's good. Can you manage that? Well, we can, but we have to take it out of 401a if that's something you'd like us to do. So you've done the 401a, separation check. Again, now you have this cash. What do I do with it? What I do with it is I invest on a monthly basis. If you have people that you work with, this is something I try to tell people in the academy, etc. Look back at your career. Many of you have spent your whole career cash poor to put all your money into deferred comp. And it's waiting for you. And that's a great thing because now you can finally use it. But if you went back in time 20 years ago and instead of putting all of it into the deferred comp, and maybe you took 20% or 25% and you invested it in something that was liquid and tax managed, that you could have used for that college tuition, the pool, a wedding, a retirement, whatever it might be, I bet you most of you would say that could have come in handy. So now as you retire, putting that money in over the next 10, 20 years does two things. It increases your net worth, but it also provides all the support to your other financial accounts. You didn't get to 500, a million, whatever you have in there by getting a $500,000 check that doubled. It was the first 25, 50, 100 you put in 30 years ago. It's the same thing. You don't have to step out of your wheelhouse. Do what you've always done. Instead of coming out of your paycheck, it's going to come out of your bank account. Remember, deferred compensation. Certainly, great funds at T. Rowe. You might want to leave some or all there. Reallocate. You're now retired, especially if you don't start a new account. Do you really want to be as aggressive as you've been for the last 30 years? Maybe, maybe not. I certainly don't think you should move it all to a guaranteed stable fund because now you're retired, because nobody's ever going to pull all that money out at once. You want to let it work. So maybe, like I said, maybe you reposition some of your assets that are going to be your distributions for the next couple of years. Maybe you leave the rest to grow for the future. Certainly, if any of you have spouses that have 401ks, 403bs at school that you like us to take a look at, we certainly do a lot of 403bs in different school districts because we have a lot of clients that do that. We can help you out now or in the future with that for sure. Inheritance. In this case, we're going to speak towards your inheritance that you might be leaving to somebody, right? Some of you have probably dealt with this with your parents, right? As you get older, you're probably going to look at things like irrevocable trusts, right? To get houses out of your name, etc. Make sure all of your beneficiaries are up to date, right? You might have had 2 kids, never got around to adding the third one. I being the first one, that usually isn't what happens to me. But, I'm one of 7, so I don't know if the 7th one's gone there. So understand beneficiaries are important. You don't need to run out and get a will because you have a deferred comp. Any retirement account that you have, any account that you'd have with us, any account that you have with an advisor should have a beneficiary on that. That supersedes a will. Another thing I try to tell people, right? And I didn't know this till like 5, 6 years ago. So if you don't know it, it's not on you. Your bank accounts. Make sure you have beneficiaries on your bank accounts. I'm not telling you to have a joint owner. I'm not telling you to put your son or daughter on. But if you don't have a beneficiary on that account, it's going to probate. So something as simple as walking into your bank the next time you go in there, hopefully it's not just a bunch of ATM machines. Talk to somebody and say, I'd like to add beneficiaries on my bank account. It's a tremendous thing that a lot of people miss. When we talk about pension options, back to the beginning for a little bit, one of the things that none of us can control, you might have saved and saved and saved, and some of you in here might have $1.5 million, $2 million. Some of you might not have that much. But one thing we don't know is how healthy we're going to be. So understand again, one way you can provide long-term care for your spouse, especially if you're a part of a 2-pension family, is to take a little bit of a richer pension option. Because now that you have all that guaranteed income coming in, less strain on the investments, less strain on kids, less strain on things that you might not otherwise want to take for yourself. So, Social Security, another question I get asked a million times, right? When should I take it? Well, if you're not working, I take it as soon as I'm available, because I don't know how long I'm going to be living. 62, break even is 78. So I don't like that math. If I take my $2,000 a month instead of waiting to get $2,600 and I invest it, I guarantee you I'm beating 78. I can leave more money to my kids. I can use it. And who knows what's going to happen? Do I think that Social Security is going to become insolvent? No. I don't think that's ever going to happen. Could it? I guess. It's not the reason. Give me $2,000 today. Let me invest. Let me do whatever I want to do. Pay down debt. Do whatever I have to do. Versus me waiting 5 years to get my first check. I just think that's kind of common sense. Now, if you're working, different story. Then you hold off. Let it grow. Okay. Blue Line Wealth Management, the 2-second commercial. Yes, Lou mentioned that we are in the PBA office, first floor. Happy to see anybody at any time. If you want to come in, take a look at, hey, Scott, are these deferred compensation positions where I should be? Do you want to come in and really get soup to nuts, look at different accounts, talk about my pension options? Does life insurance make sense? Hey, my son just got a job or my daughter got a job. They have a 401k. I'm only familiar with T-Row. Can you look at it? Hey, I just had a grandson. Should my son or daughter look at life insurance? Anything that comes down to helping you out in a financial situation, please give us a call. I can't tell you how many times I get a call saying, hey, does it make sense? Should I look at this loan versus this loan? This is what we're here for, and it doesn't cost you anything. Give us a call. Let us be a resource. We've been doing this now, I think I'm just shy of 25 years. There's probably not too many questions I haven't heard, which by me saying that, I'm sure somebody's going to ask a question I haven't heard and maybe I don't know the answer. But if I don't know the answer, I'll do my best to get you that answer immediately by the end of the day. Obviously we work with a lot of different PBAs on Long Island. And the bottom one, I don't take this lightly. We care. Courtney cares, I care. Everybody that works in our office cares. I was the son of everybody out there, right? I know what it's like to miss Christmas. I know what it's like to try to stay awake, to make sure, your dad got home, and sometimes wondering if that was not going to happen or if it was. I know all about that. And my brother's a cop now. My grandpa was a cop. Clearly my dad was. So we understand the police family. We also know that you don't have to take the same risk as everybody else in your investments. Granted, you took a lot during your working years. You don't have to hit home runs in retirement. Singles and doubles get you to the Hall of Fame. And if you get a nice balanced portfolio, especially right now, the Fed is cutting interest rates, bonds should go up. You don't need to be 100% equities anymore. You can do 7 to 10% in a nice balanced portfolio. You don't need to be 100% high octane anymore. Because the truth is, The difference between making 7 and 10% isn't all that much, especially when you have a lot of cash. Last thing, because I was asked a little bit too about, this is a rocky time. We're a week away from an election. What should I do with my money? Is there anything I really need to be concerned about? The reality is, if you track back the history of the presidents, the returns are basically the same. Scott, this one's different. Is it? It's probably not. My honest expectation is if President Trump were to happen to win the election, I think we get a rally right off the bat, and then I think it sells off a little bit and we get to a certain point. If the vice president wins the election, I think we get a sell-off and then we get a rally and we get to the same point. So either way, whatever your risk tolerance is, if you decided, and you might have done this already, like, hey, I don't want to be a part of this, I want to move my money over to the sidelines, that's fine. You already made that decision. It doesn't mean go back in lock, stock, and barrel. What it means is, over the next couple months, start putting your money back to work. And you could do an analysis and track it, not take my word for it, but I always use this example. Bill Clinton or George Bush II. Bill Clinton was the president during the dawning of the internet. He had nothing to do with the internet, but the market performed exceedingly well. George Bush, number 2, had nothing to do with Lehman Brothers that caused the Great Recession in 2008. And he's looked upon as not the best economic president. Now, if I talk to either one of them, I don't know whose policies I would agree with more, et cetera, but the point is, it's the timing that you're the president. What is going on right now? 1, interest rate cuts, pretty positive for markets. 2, we're at the dawning of the AI situation, right? Which could be comparable to the internet. So if I'm you and I'm sitting out there, I do want to be a part of markets, but I also want to do it in a measured place. So with that, I'd just like to tell everybody, thank you for listening to me today. I'll certainly answer any questions that you might have. But know that I keep each and every one of you in my prayers every night when we go to sleep. And so if there's any questions, I just want to say thank you, but happy to answer any questions. So the 401A is taxed exactly the same as deferred comp or any IRA is, depending on how old you are. So if you're 59 and a half plus and you're in New York State, your first $20,000 would be not subject to state tax, and you'd pay state and federal on anything above that. Same thing with deferred comp, same thing with a 401k, right? The penalty situation for a 401A is if you meet those 2 criteria, 25 years of service and or turning 50 in the year you retire or above, you have no penalty. If you move money to an IRA, it's 59 and a half unless you use it for the certain pre-qualifiers, one of which is college tuition. But there's nothing special about the 401A after it gets in there. The one special thing is you do not pay FICA on the money on a deposit. Deferred comp you do, 401k you do, it's the only plan that you do not pay that. Did I answer that good? Did I answer that enough? Okay, sorry. Any other questions? Yeah, if everybody could just give me 1 second, I just want to show you the effect of that partial lump that I was talking about here. If it doesn't work, I'll just close down. But so what we talked about, right? You take a $500,000 partial lump sum and you invest it over 12 years, doubles at 6%, you're going to have $1 million. You take it all out, $700,000 after taxes, right? Here we are taking the exact same amount of money we funded every year for the same 12 years. We get to 700, clearly not the million, but it's the net take home that matters, right? For our kids, if this is what it's for. So my point is, you're getting basically the same number. Now, remember, if we take the plop, there's no new money coming in for you. Here, that 37.5 is coming in every year. And let's get real. Nobody's putting the exact same amount of money that they were going to get from the partial lump sum. Cord, hold this for a second. So let's take a more logical approach to this. So if you take $1,000 a month and you invest it, over the next 12 years, you'll have $225,000. Take that same 1,000, do it for 20 years, you're going to have $500,000. When you look at your scat check and you might net $100,000 cash after taxes, etc., that's 8 years of funding this. while on top of that, you're getting your pension every month. You'll never feel this whatsoever. You're gonna expand your net worth by $500,000. You're gonna leave an extra $500,000 to whoever you might wanna leave that to. You're gonna support all the other assets that you have. It's such a simple thing. You don't need to drastically reduce your pension. You can change this 1,000 to 500. All of a sudden, you get Social Security at 62. Hey, Scott, bump me up to 1,200, 1,500. Hey, it's Christmas time. Hit pause. Start me again in March. Whatever you want to do, you can use it. It just makes so much sense, and it's the same thing you've done for the last 30 years. So, I know that's super exciting. With that, I'm going to ask one more time. Does anybody have any questions? If not, thanks again, everyone. Stay safe. Appreciate it. And I'll hand it over to Mr. Reithman.